probably heard a fellow Canadian say, "What's the point in earning more money? You'll just have to pay more taxes." Well, it's true that earning more income means some of that money will be taxed at a higher rate. You're still better off trying to earn more. And by understanding how Canada's income tax works and how to keep as much of your money as possible, you can come out ahead when tax season rolls around. First, let's look at what income tax is. For every dollar you earn, you owe a portion to the federal and provincial governments. That money pays for everything from highways and the military to schools and hospitals. The amount of tax you pay depends on how much you earn in a given year. That's because Canada has a graduated tax system. So it's true that if you earn more, you'll pay more. But it's not that simple. The reality is that you're taxed progressively. So even if you're in a high tax bracket, much of your income will still be taxed according to the lower tax brackets. Since provincial tax rates vary, let's look at how this works for federal income tax. The 2021 federal tax brackets are 15% tax on the first $49,020 of annual income, 20.5% tax on income from $49,020 to $98,040, and so on. So if you made $30,000 that year, your tax rate would be 15%, which means you'd pay $4,500 in federal income tax. Now let's say you got a big promotion or a new job and you made $60,000. Your first $49,020 would still be taxed at 15%, and the extra $10,980 would be taxed at 20.5%. So you'd pay a total of $9,063.90 in federal tax, and most of it would be in the lowest tax bracket. But filing a return doesn't always mean you'll have to pay a hefty tax bill. If you're like many employed Canadians, your employer will automatically withhold your income tax each time you're paid. And when you file your tax return, you'll learn whether you've already paid enough tax for that year. If you owe the government more than your employer set aside, you'll have to pay the difference. And if you owe less, you'll receive a refund. But even though a refund might feel like free money, it's actually your money, and it means that you gave the government an interest-free loan during that year. So if you get a refund every year, you might want to reduce the amount your employer withholds so you can invest it properly. When you prepare your tax return, you may find opportunities to pay less tax through deductions and tax credits. Deductions reduce the amount of your income that the government considers taxable. They include things like RRSP and pension contributions, as well as childcare expenses. You can also pay less tax if you're eligible for credits, which includes the child tax benefit, caregiver credits, GST and HST credits, and credits for tuition or interest on student loans. To take full advantage of tax deductions and credits, you may choose to file your return with a professional, especially if your taxes are complicated because you have more than one source of income. Even though you'll have to pay for the service, their knowledge of deductions and credits could make it a good investment. But if your tax return is simple, there are low-cost and even free applications and websites that make it easy to file your own return. Just remember that you have to file every year, even if you didn't earn any money, and you have to disclose all of your income. The last thing you want is to be penalized for filing an incomplete return. And staying on top of your taxes is an important part of your personal finance journey.